Moody's has cut America's credit rating for the first time since 1917, from AAA to AA1, below Australia's credit rating. The United States has held on to its AAA rating through the post-First World War recession, the Great Depression, World War II, Korean War, Vietnam War, the oil crisis of the 70s, the dot-com bust, the GFC and the pandemic. But it couldn't survive the Trump administration's 2025 budget, with big tax cuts to be offset by spending cuts. Moody says it doesn't believe the spending cuts. Treasury Secretary Scott Bessent says, who cares? Qatar doesn't, Saudi doesn't, UAE doesn't. Markets will probably care more than Qatar. The US share market closed higher before the Moody's announcement, but the US dollar fell a bit afterwards and the interest rate on US bonds rose and Asian markets went down. The local share market fell 0.6% because of some spirited selling of globally focused stocks like Macquarie, BHP and Woodside, and that followed falls in the prices of iron ore, base metals and gold, although crude oil went up. And the Aussie dollar is trading roughly steady at 64 US cents. Ahead of tomorrow's interest rate announcement, here's a graph of house price gains in the 2 years after the start of the previous 10 rate cut cycles. Now, the least was 5%, the most 60% after 1998, and the average 20%. Now, Cotality has produced some graphs of the percentage of houses worth more than $1 million. Nationally, it's a bit more than a third, and there's likely to be a lot more in 2 years after 4 or 5 rate cuts. But check out Melbourne and Sydney. The percentage of $1 million houses in Sydney is twice what it is in Melbourne. And that's finance.